Shukla, President Director at JK Lakshmi Cement, is now joining us to talk more about numbers. Shukla, thank you very much for your time. First of all, your registered volume growth this time was around 10% on a sequential basis and 1% on a yearly basis, which is slightly lower than what the street was penciling in. Given that the cement industry is still feeling the heat of elections, unseasonal rainfall, labor shortages, and currently the demand is soft, how are you looking at things on ground and what's the guidance for the full year?
April, June, yes, is going to be a little sluggish because of the national election which is happening. Demand is going to be on lower side. But I suppose that demand is going to be better in coming quarter, which is typically low in case of cement because July, September typically low months for us. But it's going to be better than previous year, I suppose, because whatever demand, pent up demand will be there, that will come somewhere around July and September. August is going to be, a little more rain. So maybe I think July, September is going to be better than July, September last year. April, June, yes, of course, because of the national elections, it's going to be subdued.
Okay, no, I understand around elections the volume might be sluggish, but for the entire year, what should be the volume expectation for the industry and for yourself?
Yeah, so industry demand is likely to grow somewhere around 6 to 8%, given the fact that April, June demand is lower. So on a overall basis for the year 25 is going to be around 6 to 8%. That is what we estimate. Our growth is going to be somewhere around early double digits. So maybe 10 to 12%. That is what we are targeting.
Right. Shukla, the cement channel checks are still suggesting that cement prices have declined 2.5% in May itself so far, meaning thereby that a large part of the price hike of 6% has already been reversed, which happened in April. Do you expect further price cuts from here on over the next coming months?
I think once demand picks up, which I suppose in the month of June, once elections are over, demand is going to pick up. And then prices also will improve because once 4th June result comes and things are getting a little bit better in terms of stability, then I think demand will come up in the month of June, and I don't think prices are going to drop further. It will improve from here because demand will inch up definitely.
Sure, and the EBITDA per ton has improved sequentially versus the contraction that we have seen for most of the other industry players. What do you think you're doing differently? And if you can leave us with a guidance in terms of what EBITDA per ton could be in the coming months and quarters?
Yeah, so I'll just take your first part of question first. So we have been working on achieving, EBITDA by controlling all those things which we can control, right? So on efficiency part, manufacturing cost, supply chain efficiency, top line efficiency in terms of, product mix, segment mix, and geo mix. So all those actions we have been taking for the last more than 18 months now. And in fact, I have told earlier also that our first target is to achieve, cross this, 1,000 rupees per ton EBITDA barrier, and which we have done. For the last 2 quarters, we are crossing 1,000 rupees EBITDA per ton. And the direction which we have taken, I think, is all right. It's working for us very well. I hope that our EBITDA in the coming months and coming this year also is going to be amongst top 3 to 5 companies in terms of per ton EBITDA. So that is what I see. In fact, last quarter also we are amongst top 5 companies in terms of EBITDA per ton. So we want to keep our position that way in coming years as well.
Right. We also understand that you have set an aim of becoming among the top 3 to 5 players as far as your EBITDA in per ton levels are concerned. But can you help us in understand what absolute EBITDA plus ton are you actually aiming for?
I think better would be to really, relative term, right? Because some of the things marketplace, how dynamics play out, that is not in our control. So what we are focusing on to really be amongst top 3, top 5 companies in terms of EBITDA per ton. But definitely our endeavor is to be beyond 1,000 rupees this year as well.
And you've also announced new Capex plans and expansion, right? What's the timeline that will come on stream? What will the capacity be, let's say 2 to 3 years from here on?
We have announced additional 4.6 million ton capacity addition, and that is there in East. We are going to put up a second clinker line, grinding station at Durg, Chhattisgarh, and then other, 3 grinding stations. So put together 4.6 million ton in central and eastern part of India. In western part of India, 1.35 million ton we are putting up at Surat, and we are going to commission that plant somewhere around quarter three of this year, right? So Surat will come into effect by quarter three, end of quarter three this year. So we'll add another 1.35 million ton, and with 4.6 million ton also, I think at least we'll be able to commission another, 2.5 million ton. So next 2 years, I see at least, we'll be adding, 4 to 5 million ton. That is what our plan is. And by 27, we'll be adding up about, 7 billion.
Mr. Shah, this addition which you're talking about, how exactly will it be funded and how much is your net debt expected to go up because of this funding?
So yeah, we have announced a capex of 2,500 crore for 4.6 million ton, and around 230 crore for 1.35 million ton expansion at Surat. So that is what I think the projected capex is. Funding is typically, I think our balance sheet is quite good. Net debt EBITDA almost, I think, nil. Some debt is there on account of our subsidiary expansion at Udaipur Cement Works Limited. So it's going to be typically 2:1 funding. So 2 debt and 1 internal accrual.
Okay, sir, on that note, we'll let you go. Good chatting with you today.
If you like this video, then like, share and subscribe to ET Now.